We just covered a whole bunch of information. I hope that things are getting clear now, and if not, don't worry. We'll get there. What I'd like to do now is take you through an exercise that'll hopefully make this all a little bit more relatable. Imagine that you're about to head off on a road trip. Maybe you're going across the country or to a new country altogether. Either way, there are 4 really important things to consider. Your destination, the place you want to go, your vehicle, what you're going to use to get there, your passengers, who you want to take along the way, your route, how you're going to get to your destination. These are all important to consider because if you miss just one, the whole trip might be doomed. If you don't know where you want to go, you'll have no direction to head towards. If you don't choose the right type of vehicle, you might be restricted in what you can do or take, not giving you the most out of the experience. Your passengers can either make the trip a blast or make the entire thing miserable. And your route will determine what you see, feel, and experience along the way. If you've ever been on a road trip, it's easy to think about how these 4 things could influence your trip. After you've taken a road trip, you've likely reflected on the experience and made note of what you'd do differently, depending on how things went. Like maybe you'd use a roomier vehicle to make it more comfortable, or a more fuel-efficient vehicle to make it more affordable. Maybe next time you'd go somewhere else, or take a new route to see different things. Or maybe you'd plan to bring more people with you on your next adventure. If things are making sense so far, let's imagine that instead of going on a physical road trip, you're going on a financial road trip. We can use these same 4 considerations, just slightly modified, to help you get to where you're going. Here's what I mean. Your destination becomes your financial goal, what we're ultimately working towards. Your vehicle selection becomes the account you'll use to get there. Your passengers become your investment style and professionals you use, and your route becomes the investments you choose to get you there. If you're still with me, let's dive into each one a little bit deeper. Just like how it's important to know where you're going to end up when you head off on a road trip, we want to get as clear a picture as possible when it comes to our financial goals. This really helps us in a few important ways. By having a clear picture of where we want to end up, we can figure out how to get there from where we are today. Our goals will change over time, and they're supposed to. But if we know what's important to us and where we want to end up, we can always head in that direction. The more connected we feel to our future self, the easier it is to prioritize actions today that will benefit them. We can become more connected to our future self by having a better idea of who we want to be. This is something that we'll discuss more in the Importance of Financial Planning chapter. In an earlier chapter, I said that money can't be the end goal because money on its own lacks value. If money is the end goal, when we reach our goal amount, we'll be met with a void. So we tell ourselves, maybe I just need more money and then I'll be happy. But that simply doesn't work. Money is a tool that we can use to get what we really want. That way, when we reach our goal, we can say, great, now I can do everything that I've been planning to do. Instead of being met with a void, we're looking towards a future of excitement and fulfillment. In order to make that into a reality, we need to know where we're headed and why we're heading there. On a road trip, the type of vehicle you decide to use makes a world of difference. Traveling across the country in a sports car, an SUV, or a Sprinter van will give you totally different experiences. Each has its own pros and cons, and deciding which one is best for you will depend on your situation and what you're looking to do. This is the same way that we can think about the investment accounts that we can use. Each account will have its own pros and cons, whether it's an RRSP, TFSA, RESP, FHSA, non-registered account, or anything else. Deciding which one is best for you depends on a lot of different factors, so it isn't a simple question to answer. But when you're able to take everything into consideration, an optimal solution usually becomes pretty clear. The accounts we use are like the vehicles that we use to work towards our financial goals. Using the right accounts can help us arrive at our goals on time and more efficiently, whereas using the wrong accounts can end up being an uncomfortable and costly mistake. The passengers you choose to go on a road trip with will either make or break the trip. Having great passengers can turn the ordinary into the unforgettable, provide the support you need to lean on, and really just make the entire journey getting there so much better. I like to think of the passengers on a financial road trip as your investment style and the professionals you have in place. Investing is often a multi-decade journey, so it's important to invest in a way that you understand, at least on a basic level, and that you believe in. Every investor will experience market volatility, corrections, crashes, and even recessions. Although these things might sound scary, they are all normal and necessary parts of the investment process. If history is any indication of how the future will look, we should expect huge market moves every few years. These big negative swings will often be the toughest things we face as investors, and it can make us question our approach and what we're doing. If we're implementing a strategy that we don't quite understand or believe in, then those voices asking those questions can become louder. But if we understand our approach, understand what to expect, and have a strategy that's built to endure the market volatility, then we don't have to worry. We can move forward with confidence, knowing that whatever the market does, we'll be okay in the long run. There's a lot of different ways to invest, the biggest difference being active or passive. Active strategies often involve a team of humans who are actively trying to add value through their approach. On the other hand, passive strategies rely on low fees and trying to match returns that the market produces. Historically, the majority of active managers underperform the benchmark, largely due to high fees and human error. So I believe the biggest consideration for an active strategy is the benefit you get from their approach, not the returns itself. We'd also look at filling the car with professionals that'll make the journey easier. Whether it's an active investment manager, a financial planner, an accountant, lawyer, or whoever else might help you along the way. You should be looking for professionals who can take the load and responsibility off of your shoulders, so you can focus on what matters most. All these professionals will have an associated cost, but what you pay could be more than worth it. It's like the cost you pay in reduced fuel efficiency to bring what you really need for the trip. When you look at the space on the map between where you are today and where you want to be in the future, there's going to be a million ways to get there. Each route takes a different amount of time, makes different stops along the way, and uses different roads. Each a different total experience. This is where our investments fit into the equation. I look at a conservative portfolio, one where we would expect lower long-term returns, as being more of the scenic route option. Maybe you're not in a huge rush, you want to sightsee, and you want to get there comfortably instead of quickly. The scenic route requires more of your time or more effort to get there. That's because we expect lower returns. We would need higher contributions to get the same result. But because we expect less volatility, the road to get there is less windy with less ups and downs. On the other hand, a more growth-oriented portfolio is like trying to get there quickly and efficiently. Here we would expect higher returns, so it requires less time or effort from us, but the journey may have additional stress over the scenic route. Maybe we run into the equivalent of road construction or bad weather that makes the short term a little bit more stressful, but we know that those things will pass and we'll be on our way as expected. In both cases, we get to where we want to be, on the timeline we expect to be there within. The only difference is how the journey feels along the way. Realistically, regardless of the type of portfolio we're in, we'll feel market movements. Any route won't provide us with a risk-free journey, so it's important to choose a route that aligns with our risk tolerance and what offers the best trade-offs for reaching our destination. The financial industry is confusing, but whenever you break anything down, whether it's financial or not, you're left with a bunch of simple components and ideas. If you're able to strip things down to its simple features, it can often make it a lot easier to understand. When we consider these 4 things, we can design an ideal road trip for reaching our financial goals. Things won't always be moving perfectly, just like in the real world, but we know time and time again from our experience that we'll end up where we want to be going. When we're thinking in terms of decades, we need to keep things in perspective. If we're experiencing something that won't matter years from now, there isn't a lot of point in letting it bother you today.